This week, it's time for Security Money. The Security Weekly 25 Index has taken a beating, but so have the broader markets. In the leadership and communications section, so you do not want to become a CISO anymore. Which cybersecurity metrics matter most to CISOs today? 15 effective tips on how to talk less and listen more. I need that one. And more. Business Security Weekly starts now.
This is Security Weekly, for security professionals, by security professionals. Broadcasting live from G-Unit Studios in Rhode Island, it's the show where we explore the business of security to improve the security of business. Your trusted source for actionable insights on leadership, communication, and innovation. Get ready for Business Security Weekly. Cybercriminals are working overtime. Last year in the fourth quarter alone, phishing attacks disguised as COVID testing information increased by 521%. Barracuda has identified 13 types of email threats and how cybercriminals use them to steal money from your company or personal information from your employees and customers. Find out about the 13 email threat types and how Barracuda can provide complete email protection for your teams, your customers, and your reputation. Get your free ebook at securityweekly.com/Barracuda. That's securityweekly.com/Barracuda.
The shift to remote and hybrid work over the past 2 years has accelerated application development on cloud infrastructure. However, securing these new assets has lagged behind. Qualys CloudView, the next generation cloud security posture management, delivers an end-to-end multi-cloud security and compliance solution encompassing the entire application lifecycle from build to runtime. CloudView enables enterprises to assess their cloud security and compliance posture, identify risks and gaps, auto-remediate issues, proactively enforce best practices, improve compliance and audits rapidly and efficiently. Identify your most vulnerable cloud assets by visiting securityweekly.com/Qualys.
Welcome to Business Security Weekly. This is episode number 281, recorded October 17th, 2022. I am your host, Matt Alderman. Joining remotely are my co-hosts for this week. First, who has been here multiple weeks in a row, filling in for Ben Carr, is Mr. Tyler Robinson. Welcome, Tyler.
Thanks, Matt. Good to see you again. Another week.
Yes, another week. And also coming back for his second Security Money segment, Mr. Josh Marpet. Josh, welcome.
Hey, always happy. Let's be honest, security these days is a significant amount about business. Security money is interesting as hell.
Absolutely. Do you have a specific guest or topic that you want us to cover on one of the shows? Submit your suggestions for guests by visiting securityweekly.com/guests and completing the form. We review suggestions monthly and will reach out to you once reviewed. All right, so we're going to get into the Security Money segment. Like I said, this is Josh's second time. Tyler, have you been on for a Security Money segment before?
Yep, I was on for the last one.
Okay, so both of you were on for the last one.
Interesting.
Yes. So I always want to make sure that my co-hosts kind of understand the background of this segment, since I've been doing this for 4 years now. When I came over to Security Weekly, I wanted a way to kind of track the broader market. And so since you both know, okay, what changed? Holy cow. So the first thing I have to look at every quarter is who's no longer in the public market. So Mandiant came out of the market. They finished their acquisition with Google. They stopped trading on 9/9. SailPoint came out of the market because they were bought by Thoma Bravo, and they stopped trading on, I think, August 15th. So I had to replace both of those. Now my list is getting smaller and smaller, because there's been a lot of public companies pulled out recently. And so my list of who I can go to keeps getting smaller. So I replaced Mandiant with Leidos, and I replaced SailPoint with Darktrace. So I reset the index. Yeah. Tyler, comments?
No, those are really good ones. I was actually trying to think of who you could have replaced those with. Leidos, though, that was out of left field, and that is a fantastic fill-in right there. They do some. I've worked with some of their leadership over there quite a bit, and they do some interesting things. So well done there. Because Mandiant was a hard one to replace.
Yes, I mean They both were, actually, when you think about it. And so I had to reset the index on August 16th to bring those two in. But here's my challenge for next quarter. We know Ping's coming out of the market. Ping, also Thoma Bravo. They're going to be out of the index by the time I do this next quarter. And KnowBe4 has just accepted the Vista equity buyout, which means KnowBe4 is coming out of the market. So I'm sitting here, as I'm doing this replacement this quarter, I'm sitting here going, all right, Ping's coming out, KnowBe4 is coming out because they're both in the index. Okay, who's left? And when you start, after I put in Leidos and Darktrace, there's not a lot left. Like, I'm worried that, will I have 25 billion plus entities in? Zero Fox is there. IronNet's there, but their market caps aren't very big, and we'll cover that in a little bit. So as the market continues to consolidate, this index is actually getting a little harder for me to maintain. So we'll see.
Matt, are you saying that there's literally going to be a problem finding companies to simply put on the index? Not just the creme de la creme, but just finding any company to put on the index that meets your qualifications?
Yes, it's getting very difficult.
Oh my God, man. Here's the problem with that. How are we going to find the differentiation, the incentivization, the competition to keep everybody on their toes if they're literally not there?
Yeah. It's tough. Thoma Bravo has taken out 3 identity players in the last 3 quarters. SailPoint, Ping, and they just acquired ForgeRock. They just took 3 because ForgeRock's out now. See, ForgeRock would have been a good replacement, but I know they're coming out of the market because Thoma Bravo just acquired them like a week or so ago. So Thoma Bravo's sitting on 3 large identity players. Now, we could see them roll them together and bring them back out as a public company, and I get a replacement for one of the 3 that came out. But that's the dynamics that are happening in the public market right now. Thoma Bravo just keeps buying. Yeah.
Okay. So if that's the case, I mean, you're talking about, you're right. If they consolidate those 3 into one, like one big monster identity player, a suite of products, and bring it back out, that's fine. That's a legitimate thing to do. It makes sense. You can sell it as a suite. It's great for cross-sell, upsell, your classic land and expand, right? But on the other hand, I mean, they'll own that market, for God's sakes, on the high end of the market. I mean, SailPoint is high end, you know what I mean? Mm-hmm. Ping is like, they're going to own that market in a big way. Like, Okta, look out.
Yeah.
I mean, who else have we seen do this well though and come out with a single good product? I mean, Oracle. Oh wait, no, that wasn't
Sorry.
I mean, honestly, like, no one does this real well. So we're losing 3 good competitors that keep the market fresh, the innovation moving, and push the industry. And we end up with one consolidation, maybe, if we get lucky. And again, no one's doing that well, even at scale.
Yeah. So think about this. Thoma Bravo took out Barracuda, sold it off to KKR. So Thoma Bravo bought Logarithm, right? Like, think about all the companies Thoma Bravo have purchased over the year. Like, they're building a huge cyber portfolio, but what we're not seeing is how they're coming back out into the market. And so the overall public market for pure play cybersecurity vendors is actually shrinking right now at a time when the cyber market is a little resilient. It's not completely resilient. When I get into the index numbers, you guys will know, you'll see what I'm talking about. But you're not seeing the same bloodbath in cyber as you are in some of the other technology stocks. But the pool of public companies is getting smaller. It was actually a little concerning when I was going through it this weekend, updating everything, going, ooh, who's going to be left next quarter when I go to put this list of 25 together?
So from a historical standpoint, does that open the market for innovation and new startups to start filling
That's
some
what
of
I
those
was
gaps?
Yeah.
If you get all these lumbering behemoths, does it open the market for the small, nimble companies with a great idea to come in? Tyler, exactly. Yeah.
Other than the VC money that is now, not as readily available
Right.
for the unicorns that no longer exist.
We're going to get there too. So let me just a quick couple data points, right? So the index closed at 1357 and 46 cents. Now remember, when I started the index, 1000 was the baseline. So we're 35.75% above, but it's way down from last quarter. Last quarter, the index was sitting near 2000, right? So the markets took a beating this last quarter. The graphs are in the show notes. You can see the precipitous fall off, and then kind of we're in a really volatile market right now. You just kind of see stocks kind of going up and down, but pretty flatline since a big drop. The NASDAQ closed at 10,321.39. Now that's an increase of 55.55%, also down from last quarter. So right now, see, a quarter ago, the index was performing better than the NASDAQ. Right now, the NASDAQ's performing a little better than the index. Tech stocks have taken it on the chin for sure, but so have the cyber stocks. So it's kind of interesting. I did some summary analysis. Normally, I because of all the changes with the index, I didn't get into all the individual returns. 2.88% was the average beat for revenue, which was still very positive for the cybersecurity stocks. And that trend is very similar to last quarter. Qualys did really, really well. A couple of them fell off. There's some individual stock performances you can see, just brutal downturns as the markets downturn. Qualys actually has kept their value quarter over quarter pretty well compared to some of the other stocks. And that's because they had some really good positive growth in the last quarter, so that their stock has actually performed pretty well. One IPO last quarter, ZeroFox via SPAC. So ZeroFox is a public company now. ZFOX is the symbol. But their market cap is pretty low right now. I think it's like 510 million or something like that. It's below my $1 billion threshold to be put onto the index. So that's one of my challenges. Josh is like, there's another public company, but I tried to keep the valuations $1 billion and above, and we have companies like ZeroFox and IronNet that both went via SPACs, and they're not getting those high valuations yet in the market. And so their market caps are under kind of that $1 billion threshold, which in theory keeps them off the index, but I may not have a choice next quarter.
Do you see us going back to the days when a $1 billion company was a unicorn? It was a rare thing.
Mm-hmm. Rare thing.
Yeah, not like a snow leopard, right? To be clear, there's still 25 of those left, and we've now went to the mythical creature billions again.
I don't know. I mean, it's interesting. Like the economy. Let's be honest. The economy has not done exactly nice things to any of us recently. Okay, and it's a tough market right now, and it's a tough world. Prices are up. Inflation is going places that we haven't seen since the 70s. For God's sakes. I'm thanking God I bought a house months ago and not, now.
Yeah.
Just for comparison, a new house, 30-year fixed loan with really good credit is 7.6% interest. And yeah, you can say that again. And so, but if we get back to the point where a tech company at $1 billion valuation is 1 in 1,000, 1 in 10,000, 1 in whatever, 1 in very large number, that's going to change how people fund. That's going to change how people do SPACs. That's going to change how people buy. That's going to change the market significantly for the next 5 to 20 years.
Yes. And so you're seeing some of that. When we get into the private company funding section, we're going to talk about this because you're going to see not only the quantity of the deals coming down, but the size of the deals coming down precipitously. Like major factors down. And so there's a couple other things though. So again, from an M&A perspective, KnowBe4 by Vista Equity, $4.2 billion valuation. Now, because KnowBe4 is one of our competitors, we watch this very closely. That's still roughly a 12 to 15x return. So the multiple's still there. It's not as high as it normally would be. But to be in that 12 to 15x range for this one is actually really good. Like I said, Ping by Thoma Bravo, that was $2.8 billion. So now Thoma Bravo has 3 identity players. But some other highlights, you're starting to see some interesting. One of the things Adrian started tracking on Enterprise Security Weekly, which is where I pull a lot of the funding data from, is they started tracking layoffs. Now that's interesting, right? Because there's been a lot of high profile layoffs. Okta laid off 25 employees. IronNet laid off 55 employees last quarter. Those are public companies where is news breaking about layoffs. I have a whole list on the private company side also of layoffs, which is an interesting trend that is not promising, right? So to your point, Josh, right? I raised a lot of money. Funding's down, interest rates are up, all this stuff going on. Well, how do you conserve cash? How do you get ready for the next round? How do you weather the storm?
Lay people off.
You start laying people off.
You start outsourcing.
It's changing the formula, right? From a VC standpoint and an advisory board standpoint, it's not scale at all costs. We've been talking about this for the last couple of weeks, right? It's a conservative growth and strategic growth format that has to change that formula a little bit.
Yeah, absolutely.
So, I mean, look at the trends. You've got money that's not cheap anymore. Mm-hmm. You've got dumb money going away. It has to be smart money or it's not worth it anymore. And it's expensive money. You've got
means better decisions.
What's that?
That just means better decisions, in my opinion.
One would hope, but dear God, I've seen some crazy ones over the years. Really dumbass ones. You've got people that are saying, hey, these coders, these administrators, these security people are expensive. Why am I paying all this money for Tyler? He's expensive. And so they're going to go without security and they're going to lower the security. And so just as the regulations come in for SBOMs and zero trust and privacy on customer data and everything else, it's expensive to put the people in place to do these things. So we're going to see, I'd invest in low code, no code solutions right now. That's my thought.
And outsourcing. Lots of outsourcing.
Yes. Now, we're going to, in the second segment, there is an article around Gartner spending. We're going to dig into that one a bit because some of the numbers in there, I don't fully believe because of what you just said, Josh. Like, we're going to see some trimming in certain places. I'm not sure all of Gartner's numbers line up for me. But if I think about my investment thesis around application, user, and identity spend, well, if I were invested in identity, I just had 3 exits by Thoma Bravo in that space. Right? Data security and app security are still going to be strong, right? So you got application and, you just talked about no code, low code. I still think there's tremendous opportunities in the application side as well. But yeah.
But it's going to be shorter cycle. It's not going to be, I have 3 years to write this monstrosity of an application. It's going to be, I have 4 months to turn this thing around and get an MVP out the door. And so outsourced a development firm, you've got 4 months to get me something. And then, they're going to turn around and they're going to put something out in 4 months. And Tyler's going to come by and be like, don't waste your time with me.
That always leads to good code, right? That was always secure code.
Yeah.
And so what we're going to see some returns to the early 2000s, really, in the early 2010s. When people put out crap code and then security people came by and would literally just be like, do you want your report? I've written it already. I've done it 4 times this week. Here's your report. Go away. I mean, I literally have a friend who did that. He literally had a generic report. He's like, look, do all of these things first, then call me or I'm not worth your time.
Yep.
So, sorry. Yeah. It's going to be interesting, man.
Yeah, it is. And so you see this in the private fundings, right? So I pull a list together of all the Q3 fundings from Adrian's show on Enterprise Security Weekly. Last quarter, we had one deal that was $1 billion. Now you have to take like these top almost 10, 11, 12 deals to get to $1 billion raise, right? So yeah, Acronis took 250 million. Malwarebytes took 100 million. Bitwarden and Talon took 100 million. So you got some big funding rounds in here, but the number and the size, I mean, these numbers were bigger the last couple quarters. You saw some really big numbers in there. You see some interesting numbers from the previous rounds, right? So not that they're necessarily down rounds, but they're kind of flat rounds because they're taking the money to continue the cash runway. That's why you're seeing the layoffs. That's why you're seeing, cash conservation going on in these environments, and they're raising hopefully at multiples that are consistent with their last raise, and it's not a down round. But I'm starting to see acquisitions now that are asset sales. You know what that means, right? An asset sale means I got the intellectual property, I took some engineering resources and got it on the cheap because the company ran out of cash, right? So we're starting to see some of those acquisitions coming into the mix, which means some of these early companies that took a lot of money but maybe didn't have the conservation in place are now at the point where they can't get more funding, and they're either going to have to take equity or a down round or get bought as an asset sale.
Asset sale. Mm-hmm. And I think it's a big thing. If you were conservative in the last 5 years and kept your valuations conservative and took money carefully and extended your runway as long as you could while still providing quality product, you're probably going to be fine. But if you went crazy with your valuation, we've got 7 customers, we're $1 billion company. Wait a minute, maybe temper that expectation and that valuation slightly. I know Sand Hill Road and all those San Francisco companies love their valuations to have lots of zeros in them, but I think that we're going to see those companies that went crazy with their valuations and expected multipliers and multiples that we're just not going to see in the next year or two.
Yeah.
Plus, we see better companies and the expectations set at the appropriate place for most of these companies so they can actually be set up for success. I got really nervous as soon as I seen some of those valuations coming down and what they were trying to do with a lot of these companies. Like, no one's going to get their money back on those, and the expectations for what they're buying will never happen. So I think getting that to a better place, that's good for the founders, good for the company, good for the employees long term, but also good for the board and the VC funds that are funding those.
Yeah. And if if you're running the operations well and you're solid with customers, growth, spend, you're still going to get funding. I mean, Bishop Fox, right? A well-run company. They got another $75 million. Swim Lane, Cody and team back in Colorado took $70 million. So there you can still get money, right? But you're going to have to prove the bar now is going to be set higher. The valuations aren't going to be as crazy. But if you need to raise, you can. I just don't think they're optimal times to be raising large amounts of capital because I don't think you're going to get preferential terms. But there is still money flowing. They're just at a different valuation and at a different level than what we've seen in the past. Because the last, almost a year and a half we've been doing this, just the amount of funding that was going into some of these companies was just crazy, like crazy dollars.
I think the VCs are getting a better bang for their buck right now.
Yes.
It's the funders market right now, and they're able to do more with less money. So that just means that there's additional money for multiple companies happening, just not as much money, which is not a bad thing.
Yeah. No, and again, I think it goes back to what Tyler said. And what you said, Matt, as well. If you're a careful company, a good steward of your money, of your product, of your people, you're going to get funding. If you're trying for hypergrowth at any cost, which Tyler mentioned earlier, we're not going for that anymore. We're going for careful stewardship of all of your resources, including your money, your people, your product, your intellectual property, everything. If you have that, you'll raise money because they know you'll still be there in a year.
Yeah. Some quick acquisition, I think we're going to see some interesting acquisitions and consolidations over the next couple quarters. Companies like CrowdStrike that are doing well in the public market, I think will continue to pick up companies, but others that have raised capital recently, like Devo, picking up Logic Hub, BitSight and Flashpoint, Netscope, Recorded Future. These are companies that have been raising money, continue to perform well. They have an opportunity to go pick up some really interesting technology and innovation and bring it into the portfolio. I think those valuations are coming down. So I think it's going to be a really interesting acquisition market over the next couple quarters to see kind of who gets picked up at what valuations so that we can kind of track the overall health of the market. But this one section I added in here on layoffs in Q3. So just, Malwarebytes took $100 million, right? But they also laid off 125 employees at the same time, right? So they raised funds, but then also did some downsizing again for cash. NSO laid off 100.
Could they lay off the rest of them? That'd be great. Not fond of NSO, sorry.
Yeah, well, it was pretty big in the news. A REIT IR laid off 90. SNCC, which has performed really well. Like, again, one of these big unicorns, Josh, right? Great technology. Absolutely. I love what they do. They've done really, really well. They reorganized. Now, they don't say how many people were let go, but they reorganized internally, which is always a sign for, we got rid of some headcount, we restructured some teams and kind of consolidated, but they didn't get into specific numbers. Socure laid off 13% of their employee base. Interos.ai laid off 15% of their employee base. I didn't do the math to see, how many actual employees that was. Finite State laid off. So these are all articles in the press this last quarter, all around layoffs in the market, as these companies are trying to get themselves right sized for the norm over the next 18 to 24 months. There's no fast track out of this. I don't see it, right? I think the inflation numbers just came out last week. We're still over 8%, which means the following. We're going to see another 75 basis point increase by the Fed in November. If we see the same numbers next month, you're going to see that same 75 basis point rise in December. Okay?
Nope.
That's going to put us over the Fed target rate. Okay? That has major implications on raising money because it just got more expensive. But that's the reality of what I think we face over the next 2 months in this quarter, which means if that happens, that's another 1.5. You say 1.75, Josh, but that's a 1.5. It's going to take at least 6 months to figure out where we are, right? Which means we're well into mid next year before we see any signs of is the market going to get back on track from an investment standpoint. I think that's the time horizon in the near term, which means we do 2 more of these segments before we hit that point.
2 more of these segments before we know.
Yeah.
Honestly, I'll give you a quick off the cuff prediction. I think money's going to be expensive for at least the next 2 years. Yeah. I honestly do. I think it's going to be expensive. Funding is going to be more constrained. The rates are going to go through the roof. Is it going to be a recession, a depression? I don't know. Mm-hmm. But I think that it's going to be a very cautious investment perspective for at least the next couple of years, which means that if you're a startup and you've got enough money to have runway to get to where you are self-sufficient, have a flippin' party because that's amazing.
Yeah.
If you're not self-sufficient and you're not able to get self-sufficient, figure out who wants your stuff now.
Yes. Find your exit strategy now, not later, while you still have value.
Now.
Yeah.
Yep.
For sure.
Bingo.
All right. We're going to take a quick break, and then we're going to cover our leadership and communications articles for this week.